Chapter 14, Part 2, Unrealistic Interest Rate Installment Notes. What we're talking about here is what happens if you have a note that doesn't have a stated amount. It just has an amount that has to be paid at the end. Well, the truth is nobody gives out anything for nothing, so there is what we call implied interest. Now, notes exchanged for assets or services with unrealistic interest rates. Implicit rate of interest is the rate is not expressly stated in the agreement, so there is an implied interest rate. Imputing an interest rate, deciding the appropriate rate when value of the asset or service is not readily determinable. So let's take a look at this example. We have on January 1st, Mike Corp acquired a piece of equipment by issuing a 5-year $200,000 note at 4% and everything's payable at maturity. The market rate of interest for similar notes, this would also be the effective rate, is 10%. So now what we're going to do is we're going to record these journals. So how do you figure out the total value of what you received and how much was the implied interest? So what we have to do is we have to go to our present value tables. So what we need to look at is what is the present value of the interest of 4% times 200,000, which is 8,000, and then we're going to go to the present value of annuity table where n equals 5. That's the number of periods because it's annual, and the interest is 10 because that's the market rate. And that tells us that that 200,000 is worth 30,000. The interest is worth 30,326.32. Then what we're going to look at is what's the present value in today's dollars with an interest implied effective rate of 10% of 200,000. We're going to go to the present value table, and 5 is the years because there's no semi-annual payments, so we use 5, and the implied rate is 10%. We get this factor of 0.62092, and that tells us the present value of this note is $154,510.32, which tells us the difference is going to be the interest it's going to cost us. Now again, since interest is annual, we're not going to divide by 2 nor take the number of periods times 2 because it's annual. Now, what's our journal entry at the date of purchase? Well, we're going to now use that $154,510 as the value of the equipment. The notes payable is $200,000, and the difference is the interest that we're going to expense over time, and that's $45,490. Now we'll look at a bond amortization table. What we're saying is that we have the interest payable is $8,000. The implied interest is $15,451. So the discount that will be amortized in year one, at the end of year 1, would be $7,451. So this shows you how it works. So, for instance, for year 2, we would take the balance total value of the bond, which is the notes payable minus the discount, which gives you $161,961. And we're going to take that times 10%, which is the implied rate, and that tells us the interest is the $16,196. That's the implied interest, and the difference between the amount that's going to be amortized is $81.96. So this is our journal. I'll let you go back and take a look at that for a few minutes. So remember, you're doing this each period, so what's going to happen is your interest expense is going to change as you slowly write off the discount on bond. And in the end, the only thing that's going to be on the books at the end of year 5 is the $200,000. So our first journal entry is going to be interest payable is $8,000. Interest expense is the net value of the bonds, and then the discount on bond is the plug. So that's year 1. Now, what does it look like at the end of year 2? Now again, if you notice, the interest has changed. Interest expense has changed because now, if you notice, we have a value because we're writing off the discount. The amount is going to slowly go up, and at the end of 5 years, the net amount of the bond is going to be $200,000. So now it's $161,961 times 10%. Interest payable does not change. It's the face of the bond times the rate the bond pays, and the difference is discount on bonds. Now, if we were to look at the account, this is what it would look like as we journalize. Discount on bonds each year for the 5 years, and at the end of the year, that is going to equal 0, and then the net value of the bond is going to be $200,000. So what's going to look like when they pay it? Notes payable will be taken off the books for $200,000. The interest payable would be taken off the books, and the cash would be $240,000. Now let's look at installment payments. This is what happens when the payment is the same every single time. So you're going to have periodic reductions of the balance, which is sufficient that at maturity the note is completely paid. So instead of paying it at the end, you're going to be paying it off over time. This is what you do when you buy a car. So each payment includes interest and a reduction in the principal. The periodic amount is easily calculated by dividing the amount of the loan by the appropriate discount factor from the present value of an annuity table. So let's take a look at an example. My corporation purchased equipment for $4 million on January 2021 and issued a 4-year installment note payable in 4 equal payments at the end of each year. The payment includes interest at 10%. So we have to first determine the payments. What we're going to do is take the $4 million and we're going to divide by the present value factor of an annuity. It's 4 years, and we're going to, of course, use the 10% that it includes, and we're going to find that factor, which is 3.16987 on the present value table of an annuity. And therefore, the annual amount is going to be $1,261,881. That's how much they're going to pay at the end of each year. So, when purchased, it's going to look like this: equipment, notes payable. Now, what's going to happen next is we want to do an amortization table. Now, if you see this, if you look at every time we make a payment, we're going to take the $4 million, we're going to make a payment of $1,261,881. If you notice, that's the same for all 4 years. It's always at the end of the year. The effective rate on that balance in the first year is $4 million times 10%, which is $400,000. You subtract, and the difference is going to be your decrease in your balance. And now we're going to have a new balance of $313. So our first payment at the end of the first year is going to look like this. It's going to be interest expense is $400,000. Notes payable is going to go by $861,881. And cash is going to be $1,261,881. Now, what does it look like for the payment at the end of the 4th year? It's going to be cash, notes payable, and interest expense. And if you notice now, we have nothing left on the books. And that includes Part 2, Chapter 14.